Okay, so we're heading towards the final part of this reading, towards the fees. And let's have a look at the last few ideas on liquidity, head towards the fees here. We've talked quite a bit about watching out for private equity especially, also about areas like real estate and hedge funds. Where we have a lack of transactions, talked about the lockups, talked a bit about the gates as well. Let's now go to the other end of the spectrum where liquidity might be quite high, where we have publicly traded are ETFs, lots of chances every day to buy and sell, very, very liquid. In fact, many parts of level 3, we're often asked to compare perhaps a direct investment in something like real estate. This building that we're in here, investing in one particular building might be very illiquid, as opposed to investing more in a fund, which could be extremely liquid. If you invest more in a real estate fund, much more easy for the small investor, of course. And when we talk about the well-known, much more illiquid investments down the private equity and venture capital route, then let's bring in the famous J-curve. With this J-curve, we're looking at from years, perhaps even to a 10-year, talking about a 10-year lifespan here. Often known as the Valley of Tears. You watch Dragon's Den, that kind of TV program, you know that many of these investments, many of these entrepreneurs may never make it through to a successful outcome. But those that do, let's say you have a good spread of different investments, then it might take a few years, perhaps you might have to wait 4 or 5 years before the cash flows start to become positive. And that's one of the reasons why we have this liquidity issue, of course, too. Now, continuing our tour through different types of structure here, when we think about, again, the private equity and the hedge fund structure too, often think about limited partnerships. So you've got the general partner, and then you've got the limited partners as well. The limited partners, of course, are the investors, and the general partners being the hedge fund managers or the private equity fund managers too. And you often talk here as far as costs and fees, for many years talking about the 2 and 20, the 2 being the annual management charge. And of course that can be lower or higher, and then having a share of the profits, more like the share of the profits. And one of the things we're going to have a look at here is that they'll only perhaps share those profits in some cases if they meet minimum hurdle returns. So guys, a hurdle return or hurdle rate, only if you make that minimum. If you've made the minimum, that's when they might trigger a share of the profits. If you haven't made that minimum, we're not going to share. So where the slides are heading here is trying to incentivize the managers and kind of share the up and share the downside as well too. Now, with these partnership structures, does have the ability to have quite a long investment horizon. Also quite good from a tax perspective as well, depending upon where they're first set up as well too. So yeah, we're on to the fees now, and in general the trend about fees, and the book is talking about this general trend, that they've fallen. For example, it talks about in 2000 the average fee was just about 1%, a little bit shade under 1%, 0.99, and then moving on to 2016, something like, guys, 0.69% or so, quite a significant fall. So that the trend there is people are much more cost aware, fees tends to have come down, a lot more transparent as well. And we're going to look at a number of different structures here. Interesting that the trend here that investors have increasingly avoided these front-end loading, meaning front-end kind of sales commissions. They've increasingly avoided that and gone to structures that don't have this. for many years might have been covered up, perhaps years and years ago. A lot more transparency. Investors are more aware of this now. So one of the ideas, I guess, about fees is to create more of an incentive. The idea of fees based upon assets under management, looking at net asset values, well, it might incentivize the manager just to keep things ticking over. The idea of quite a safe strategy here, like indexing. Why? What's the incentive to keep things safe? Is just to kind of keep the money there, lock in those regular fees, and not really add much in terms of active management. Now we're going to explore a few different fee structures, and where we're headed here is where the fee is going to be changing. So where we're headed here is to have some kind of a normal fee, if you like, and that fee could vary down the way if things go badly, but it could also increase if things go well. And so you end up with a corridor of fees. That's where the chapter is heading here. Things go well, they share in the upside. Things go badly, well, I guess the fee is kept pretty low in this way here. But traditionally, we start off with the idea of having different components. The base fee, think of that more like a minimum fee that doesn't change, and then some sort of share here, some sort of share in the upside. Talked about hedge funds, the idea of having that 20% share, but in that area here, only get a share in those profits if you make the hurdle return or hurdle rate. Now there are lots of different real-life versions of this, but what I want to do is just to show you a little idea that comes up in a moment here. Let's have the net asset value of the fund, and let's bring in a hurdle return or rate. Say, for example, that happened to be 6% here. Here's our hurdle. Now in the variety of different structures here, we have what's called a hard and a soft version. So if we have a hard first, then if you make the hurdle rate, then we will share 80-20 with the manager and the investors, only on the amount above the hurdle return. But on a soft version, on a soft hurdle return, we would still share 80-20, but on the whole return. So in terms of what's being shared, it might just be the amount above the hurdle return. That's a hard hurdle return, or maybe it's on the whole return is shared as well. And one of the ideas that the book is talking about, guys, here is the alignment and incentive, the incentive between the manager and the investors to get good performance. Now, are they getting a share in some of that upside? And the thing I wanted to mention to you here, I'm just going to change our color here slightly, is when you think about the payoff here, it's a lot like a call option. Guys, it's a lot like a long call where the incentive payment is a lot like if the value of the fund rises above the strike, and the strike here is the hurdle rate, then the manager shares in the upside. So they call that more of an asymmetric payoff. They liken the payoff like a long call. Now, the degree in which we're going to share might vary. For example, here, having more of a limits involved, having some sort of a limit on what might be shared, and having some sort of guarantee about what might be always paid to them as well here. So we know in real life is going to vary. And where we're headed here is towards this performance-based fee structure, as I mentioned. Now, what we're going to see here is this idea of, I'm going to call it here a normal fee. What their normal fee would be as the baseline. We're going to allow, if performance does really well, we're going to allow some sort of a max fee. And if performance is poor, here is the minimum fee. That's where we're headed on the slides. And there will be a cap on the maximum fee that they can earn. And there'll also be this minimum fee as well. So we're only really allowing a fluctuation between these numbers. Let's have a look at an example of this. Yes, so performance-based fees benefit investors. If things don't go well, the fees start to fall. If things do go well, they're happy to share and incentivize these managers to get a bit more of a share in it as well. Let me show you the example here. Now, we've mentioned that some investments don't limit the performance, but there are some well-known caveats to that. Let's talk about the famous high watermark. This comes in particularly with hedge funds and private equity, and it's the idea that if say in year one we get a performance guys here and the fund value rises say up to 100, and we pay a fee. And then the next year, unfortunately, the fund falls down here to 50 again. If we get a subsequent rise the year after, do we pay another fee? No, we don't. There'd have to be fresh growth beyond the high watermark. So the idea of a high watermark, we're not paying fees on the same performance. Now, with something like a private equity fee, if a fee is paid, there are these clawback provisions where if there's a subsequent fall, they might claw that back. I work a lot with hedge funds, and they don't apply these to hedge funds, they apply them to private equity normally. We've talked a bit about the payoff is a lot like a call option, especially when you have some kind of a hurdle rate. If you hit the hurdle rate, you've hit the strike. And so you can think of the incentive structure here, that the hurdle rate, the fund has to meet this minimum return before there's a share in those profits. And so it's very much like the strike of a long call. Now this is a numbers example. I think you're going to quite like some numbers after all these discussions. Let's have a look at it here. Now in this example here, first thing to link into here, let's talk about number one, the standard fee. Now you'll notice that with the standard fee, kind of fits in the middle here of 0.5. We've also got here though a minimum fee. And the minimum fee, they're calling this the base fee of 0.25. Here is the minimum. Here is the standard. And then up here we have the maximum fee here being the 0.75. I want to put it up here, 0.75. So if you have our kind of lower bounds and our upper bounds here, the fee can increase or the fee can fall depending on performance. Now the driver of these numbers are of course guys the fund performance here. For example, if we have a fund performance of 2.75, that's going to trigger our maximum fee. And if we have a performance even below 0.25, we still can charge our minimum fee. Let's derive these numbers and make sure that you're okay here. Well, firstly, let's derive, guys, the maximum fee firstly. Now, remember that the way this works out here is that we get a 20% share beyond our base fee. So our base fee comes in first. So 0.25 is our base fee. And then we receive then here 0.2, and it's the amount there of 2.5. So notice, guys, that I've deducted 0.25 from the 2.75, and we notice here that this gives us 0.5. And so our overall fee here does come in there at 0.75, so 0.75 here. So what we're saying here is that the 0.25 is fixed, does not vary, but beyond our base fee, we're sharing 20% of the amount above here. For example, if we're checking out the fee earned in the middle range here, same idea. Well, we're going to earn the base fee of 0.25. Then if we add on here 0.2, and this time 1.5 is the return, so we have to take off the 0.25, so the 1.25 here, and we have 2 times the 0.125, and we end up here at 0.5. So on the slides that follow, let's have a little look at the numbers in one moment. Just a quick summary so far. What we're saying here is that the standard fee may sometimes vary upwards, but that's going to be capped at 0.75. We'll never rise above that, but at least we are allowing, should the returns rise to 2.75 of an active return, we're going to be able to charge a higher rate. As that return starts to fall, notice that the fee we can charge starts to fall as well. Back down to our standard fee, it's a return of 1.5. And as the overall return falls all the way down to 0.25, we can now only charge our minimum return. Think of it like a corridor. So looking at those numbers, make sure that you're happy with how they've come from. Just bear in mind if you're asked to calculate this here, that they only get the performance related on the amount above the base. That's why this is the base here. You only get the performance on the amount above that there. So in that 1.5 region here, if we deduct the base, it's our base of 0.25, then we can then get our overall performance fee. This is going to be the 0.25, which is the base, plus the performance related fee of 0.25, giving us the overall fee of 0.5 that we have here. Now for the exam, quite likely, as there are very few calcs in here, there could be a capture ratio or there could be a fee calc, but I think most of the chapter is going to be more discussion. The slide finishes off just talking about the corridor. That's what I would take from this example here. We said that the 0.5 is the standard. The fee can climb there to 0.75, or it could fall, depending on performance, down to 0.25. You've got the maximum and the minimum, and that incentive kind of mirroring how the investors have done as well too. When the returns are great, active return being given that maximum of 2.75, their maximum fee comes in. When things don't go so good, when the active return's way down there at perhaps even below 0.25, well, they then can only charge their minimum.